Welcome back to the deep dive. Okay, if you've ever wrestled with financial statements juggling multiple currencies, you'll know exactly what we're tackling today.
hmm
International business is complex, right? And the accounting, it just explodes. How do you report accurately when values shift daily?
Yeah, that's precisely the challenge.
IAS 21, the effects of changes in foreign exchange rates, is designed to address. And look, for anyone studying strategic business reporting, this standard isn't just, abstract theory.
Right.
It's really the bedrock for understanding trickier stuff, like consolidating foreign subsidiaries.
Absolutely. So our goal today is pretty focused. We want to give you that essential toolkit for IAS 21. Think of it as a shortcut.
Yeah, a cheat sheet almost.
Exactly. Two main things we want to nail down. First, functional versus presentation currency.
Yeah.
What's the real difference?
Crucial distinction. And second, we'll walk through how you actually account for these foreign currency transactions. We'll cover the 3 stages, but really focus on that critical year-end split, monetary versus non-monetary items. That's where things often get confusing.
That's the core of it, definitely.
Right, let's dive in. First things first, the tools. Exchange rates. If you're dealing with foreign currency, you've got to know which rate to use and when. So what are the 3 key rates we need?
Okay, yeah. 3 main ones to keep straight. First, the simplest maybe, the historic rate.
Okay.
That's just the exchange rate on the exact day the transaction happened. The spot rate for day one, basically.
Got it. The rate when you first book it. What about later, like when you're closing the books for the year?
Right, that brings us to the second one.
Yeah.
The closing rate. That's the rate on the reporting date, your balance sheet date, year end usually.
Why is that one so important?
Well, it reflects the actual market rate on the day you're finalizing everything. It's the current reality, so to speak.
Okay. Historic and closing, what's the third? The average rate. Sounds a bit approximate.
It is, yeah, it's a practical tool. The average rate is, well, the average exchange rate over the whole accounting period.
So why use an average instead of the actual rate each day?
Well, technically you should use the historic spot rate for every single transaction. But imagine a big retailer operating overseas, thousands of small sales every day.
Tracking the exact rate for every single one would be a nightmare.
Exactly.
Eh.
Impractical. So IAS 21 allows you to use the average rate as a proxy, especially for things spread throughout the year like overall revenue, maybe some operating expenses, even depreciation sometimes. It simplifies things, provided the rates haven't been, wildly fluctuating.
Okay, makes sense. Balancing precision with practicality. Now let's shift from rates to the company itself. How do we figure out a company's sort of home currency for accounting? It's not always just where the headquarters is located, is it?
No, definitely not. That's a common misconception. We need to identify the functional currency. The standard defines it as the currency of the primary economic environment in which an entity operates.
Primary economic environment. So where the real business action happens?
Precisely. It's about the underlying economics, not just the legal address.
So give me an example. Maybe a factory in one country, but everything's priced and sold in another currency.
Perfect scenario. Let's say you have a plant in Mexico, but maybe 90% of its materials are bought using US dollars. And 90% of its finished goods are sold also in US dollars, maybe to a parent company in the US.
Right.
In that case, even though it's in Mexico, the primary economic environment, the forces shaping its prices, its costs, is driven by the US dollar. The peso might not be the functional currency.
So how do you pinpoint it? What factors does IAS 21 say to look at?
It gives clear indicators. You look at the currency that mainly influences sales prices, the currency of the country whose competitive forces and regulations mainly determine those prices, and, importantly, the currency that mainly influences the costs, labor, materials, things like that.
Okay. So you weigh those factors.
Yeah, you weigh them, and usually they point quite clearly to one currency. That's your functional currency, the engine room currency, if you like.
Got it. And then what about the presentation currency? That sounds simpler.
It is much simpler. That's just the currency in which the financial statements are presented. Full stop.
So the Mexican factory might use the US dollar as its functional currency,
Right, because that's its main operating environment.
but maybe its ultimate parent company is in Japan and needs consolidated reports in yen.
Exactly. So the factory's statements would be translated from its functional currency, USD, into the presentation currency, Japanese yen, for the final report.
Okay, definitions sorted. Historic, closing, average rates. Functional versus presentation currency. Now, let's get into the mechanics, the actual transaction flow. You mentioned 3 stages.
Yes, a three-step process for any Foreign currency transaction. Stage 1, initial treatment. This is day 1.
What happens?
You just record the transaction. Could be a sale, a purchase, taking out a loan using the historic rate, the rate on the day it happened. Simple as that.
Okay, initial recording at the historic rate. Now, stage 2, settled transactions. This is when the cash actually moves, right? Payment is made or received.
Correct. And this is where things get interesting. When you settle the transaction, you translate the cash flow using the historic rate on the settlement date.
Ah, so probably a different rate than the initial transaction date.
Almost certainly. Rates fluctuate, and this is key.
Hmm.
Any difference between the amount you initially recorded and the actual functional currency amount you paid or received.
Yeah, what happens to that difference?
That difference is an exchange gain or loss. And because the transaction is now complete, cash has moved, it's considered realized. It goes straight into the statement of profit or loss, SPL,
Yeah.
immediately.
Okay, hits the P&L right away. Let's use that Collins Co concept from the material to make this concrete. U.S. company, functional currency is dollars, buys goods priced in kroner, KR.
Right. So Collins Co. owes KR 54,000. On the day they bought the goods, let's say the rate was KR 1.80 to the dollar. So initially they record a payable of $30,000. 54,000, 1.80.
Okay, 30K liability on the books.
But then maybe 2 months pass. The dollar weakens against the kroner. The rate moves to, say, KR 1.75 per dollar. Now, to actually pay off that KR 54,000 debt,
They need more dollars.
exactly, they need $30,857 series, 54,000, 1.75.
Whoa, hold on. They booked $30,000 but had to pay out nearly $31,000.
Precisely. $30,857 cash outflow versus the $30,000 initial liability, that extra $857.
That's the loss.
That's the realized exchange loss, and it goes straight to the SQL. It's a direct hit to profit, a real cost of doing business across currencies.
Okay, that makes sense for settled deals, done and dusted. But the really tricky part, I think, is stage 3, unsettled transactions. This is when you hit the reporting date, year end, whatever, and you still have amounts outstanding. Receivables you haven't collected, payables you haven't paid. These are unrealized risks, right? How do we handle those?
This is absolutely the core distinction in IAS 21 at the reporting date. You have to draw a clear line. You must separate your outstanding balances into 2 categories, monetary items and non-monetary items. Their treatment is fundamentally different.
Okay, let's break that down. Start with monetary items. What are they and what's the rule?
Right. Monetary items are basically assets and liabilities that represent a right to receive or an obligation to pay a fixed or determinable amount of cash.
So like receivables, payables, loans, cash itself.
Exactly. Those are the classic examples. And the rule for monetary items at the reporting date is absolute.
Okay.
They must be retranslated using the closing rate.
Retranslated using the closing rate. Why? What's the logic behind that? Why make them follow the market rate at year end?
Because they represent future cash flows, whose value in your functional currency changes every single day the exchange rate moves. If you owe money in euros, the number of dollars you'll eventually need to pay depends entirely on the euro-dollar rate on settlement day.
So the company's still exposed to that currency risk.
Completely exposed until it's settled. IAS 21 says you have to reflect that ongoing risk and uncertainty on your balance sheet. So you update the value to what it would cost to settle today using today's closing rate.
That connects the rule to the risk? Okay, let's use the Wilkie Co. example again. They had a payable, right?
Yes. Imagine Wilkie Co. bought goods, creating a payable of, say, D35,000. Initially, maybe that translated to $20,000 in their functional currency.
Okay.
Now, fast forward to the reporting date. The exchange rate has changed. Let's say the closing rate means that D35,000 is now only equivalent to $18,421.
So the debt, in dollar terms, has actually gone down.
Exactly. The liability is smaller in their functional currency. That drop of $1,579, $20,000, $20,000, $18,421 closing.
That's a gain for them, surely.
It is. It's an unrealized exchange gain. But even though it's unrealized, they haven't settled the debt yet. IAS 21 requires it to be recognized immediately in the SPL.
Straight to the P&L again, even though no cash has moved.
Straight to the P&L, because the balance sheet needs to show the most current estimate of the eventual cash outflow. The potential gain is real, economically speaking.
Okay, monetary items chase the closing rate, differences hit the SPL. Now, what about the other camp? Non-monetary items. What falls in here? Things like inventory, property.
Exactly. Non-monetary items don't represent a fixed cash receipt or payment. Think inventory, land, buildings, equipment, PP&E generally. Their treatment depends on how they're measured after initial recognition.
Okay, so what if they're measured using the cost model? like most inventory, or maybe some basic equipment.
If they're on the cost model, they simply remain translated at the historic rate, the rate from the day you bought them. They are not retranslated at the reporting date.
Wait, so they just stay at the original translated cost, even if the currency has swung wildly?
Yes. They are effectively shielded from year-end currency fluctuations on the balance sheet itself.
Why the difference? Why are they treated differently from, say, the payable you used to buy them?
Because the entity's cost of that item is considered locked in at the transaction date value. The future cash flow risk isn't really tied to the asset itself anymore. It's tied to the monetary payable used to acquire it, which we just discussed as retranslated, or the eventual monetary receivable you get when you sell it. Once you have the non-monetary asset at cost, that cost is history, literally.
Okay, historic cost stays historic. What if it's a non-monetary asset measured differently, say a building under the revaluation model?
Good question. If you revalue it, you obviously update its carrying amount to fair value. Now, that fair value calculation will naturally incorporate the exchange rate on the date of the revaluation.
Right.
But, and this is important, IAS 21 says any exchange component within that revaluation gain or loss is not separately pulled out and put in the SPL as an exchange difference.
So where does it go?
It's essentially bundled within the total revaluation movement. If it's a revaluation gain, the whole amount, including the embedded exchange effect, typically goes to other comprehensive income, OCI, into the revaluation surplus and equity, not the P&L.
Okay, so cost model, historic rate, no change. Revaluation model, rate at revaluation date, but bundled into OCI gain loss.
Broadly, yes. And just a quick practical point. Remember, we said exchange differences often hit the SPL.
Yeah, for monetary items and settled transactions.
Right. You also need to classify where in the SPL they go. If the difference relates to normal trading activities like receivables or payables from buying and selling goods, it usually goes into operating income or expenses.
Right.
But if it relates to financing, like a foreign currency loan, the exchange difference usually gets classified with finance costs or interest income. Just keeps things tidy.
Right, classification matters. Okay, this monetary versus non-monetary split is clearly the absolute key. Let's really hammer it home with those specific examples from the source material, because seeing inventory treated differently from the related receivable, even though they stem from the same event, is where it clicks, or maybe it confuses.
Agreed. Let's use that KR 200,000 example. A U.S. entity makes a sale overseas. The customer owes them KR 200,000.
Okay. Before the sale happens, those goods are sitting in the warehouse as inventory. That's non-monetary measured at cost, right?
Correct. So let's say the inventory cost, when translated originally, maybe using a rate of KR 0.65 to the dollar, was $307,692.
Right.
Now, year-end comes. Let's say the closing rate has changed significantly. Does the value of that inventory on the balance sheet change due to the exchange rate?
Based on what you said,
Yeah.
no, because it's non-monetary at cost.
Exactly right. The inventory stays on the books at $307,692. It's fixed at its historic translated cost. No adjustment for currency movements.
But the instant that sale happens, the inventory disappears, and we now have a receivable for KR 200,000. And that is monetary.
Correct. And monetary items must be restated at the closing rate. So if the closing rate has now moved to, say, KR 0.75 to the dollar.
The value of that receivable drops.
Yes. KR 200,000 divided by 0.75 gives you only $266,657.
Wow. So it started effectively as inventory valued at over $300K becomes a receivable, and by year-end, that receivable is only worth $266K. That's a huge difference.
It is. And that difference, $41,000, $25,000, $307,692, our initial value implicitly recognized at sale, less $266,067.67 year-end value, represents an unrealized foreign exchange loss.
Which goes where?
Straight to the statement of profit or loss. It's a direct hit. Shows the risk perfectly holding that foreign currency receivable while your home currency strengthens against it costs you money on paper.
Okay, that really highlights the difference. Now flip it. Let's look at buying an asset. Say a company buys land for KR 100,000 but on credit. Land is PP&E, so non-monetary.
Right. Let's use the rates from the example. Acquisition rate is KR $0.85, $1. So the land is initially recorded on the balance sheet at $85,000. $100,000.85.
Okay, $85K for the land. Year-end comes. What happens to the land's value on the balance sheet? Assume it's held under the cost model.
It stays exactly the same. Land remains recorded at its historic cost, $85,000. In non-monetary cost model, No retranslation.
They bought it on credit. There's still a trade payable of KR 100,000 sitting there, and that's definitely monetary.
Absolutely. And monetary liabilities must be restated at the closing rate. The example says the closing rate moved to KR 0.92 tals $1.
Okay, so the payable needs restating. KR 100,000 divided by 0.92. That's $108,696. Oh, wait, the example used 0.92 slightly differently. Let me reread. It says the liability becomes $92,000. Maybe the rate was $1, KR 0.92. Let's assume the retranslated payable is $92,000 based on the closing rate in the source.
Yes, let's stick with the outcome provided. The trade payable is restated at the closing rate, making the liability $92,000.
Okay, hold on. The asset, the land, is stuck at $85,000. But the liability needed to buy it has just jumped to $92,000 at year end. That feels unbalanced.
It does initially, but it reflects reality according to IAS 21. The land's cost is fixed. The obligation to pay, however, is exposed to currency risk. That difference, the $7,000 increase in the liability, $92,000 closing value minus $85,000 initial value.
That's another loss.
It's another $7,000 unrealized exchange loss hitting the SPL. It shows that settling that debt today would cost $7,000 more in functional currency than it did on the day the land was purchased. The balance sheet now reflects that increased economic burden.
Okay, I think that nails it. The examples make the monetary-non-monetary split crystal clear.
It's the absolute cornerstone for year-end adjustments under IAS 21.
So, wrapping up this deep dive, if there's one core principle listeners should take away about handling foreign currency transactions at the reporting date, what is it?
It has to be this. Monetary items, receivables, payables, loans, cash, they chase the market. They must be retranslated using the closing rate, and the gains or losses typically hit your profit or loss.
Because they represent actual fluctuating future cash flows.
Exactly. Whereas non-monetary items, especially those measured at cost like inventory or basic PP&E, they're generally stable. They stay put, recorded at their original historic translated rate. Unless, of course, they get revalued, which is a different story.
Monetary items move, non-monetary items at cost stay fixed.
Got it.
That really covers the transaction level accounting. But, if we zoom out a bit, think about the bigger picture for reporting. We've seen all these gains and losses hitting the P&L. It makes you wonder, are there times when an exchange gain or loss would not go through profit or loss?
That's the perfect question to leave things on because, yes, there is a major exception we haven't touched on today, but it's critical for understanding consolidated accounts.
Right. We focus purely on transactional gains and losses hitting the SPL, but think about consolidating an entire foreign subsidiary, a whole separate business operating in a different functional currency. When you translate that entire subsidiary's balance sheet into the parent company's presentation currency, the resulting exchange differences, the ones arising from translating the parent's net investment in that sub, IAS 21 generally sends those differences not to the SPL, but straight into other comprehensive income, OCI. They get parked in equity.
To avoid huge swings in reported profit just from currency movements at the consolidation level.
Exactly. It smooths the consolidated P&L. So transactional impacts often hit profit directly, but consolidation impacts on the net investment usually go to equity via OCI. That's a whole other layer, maybe for another deep dive, but a crucial distinction to be aware of.